Hello. In this video, I want to give you kind of a brief overview of capital budgeting and some of the sort of important facts about it. From there, we'll roll forward to actually talking about some of the metrics that get calculated and going through the process. So, first learning objective I have for you, I want you to understand and describe the issues that arise when a firm's trying to make investment decisions, and then describe the capital budgeting process, kind of the steps and how they can help address those issues. The capital budgeting process is the process, it's the label we use for the process that most firms use when they're deciding what things to invest in, how much to invest, all of that sort of thing. So, if we just think for a second about the investment decision, you as a company, whether it's an individual or you as a committee, an investment committee, or however it is, typically have more than one idea that you might invest in. And so, one of those may be a project to upgrade some equipment, another one may be to invest in a marketing program, another one may be to take the money and put it into some sort of stocks or bonds. And so you've got these choices of what you might do with the money. And understand that all of those are very different choices. They may involve different amounts of money. They may involve different timing of when the money gets returned. And you first have to make the decision, are any of these projects worth investing in? And then secondly, if they are, you have to figure out which ones are worth investing in and figure out how much money you have to invest and sort of, figure out what you can afford to do. So there's whether we should do anything, any of them are any good, and then assuming they're good, that some of them are good, then we potentially have to pick and choose between them if we don't have enough money. So the challenges then become, I'm looking across all these different ideas and they're very different, and I need to understand what should I be looking at in terms of making the decision. How can I put them sort of on an apples to apples basis so that I can consistently describe them and compare them? And what would I do if the projects are of different risk? How do I incorporate the fact that they may, if I just looked and said what I expect to happen, that I've got two projects where I expect the same thing to happen, but the riskiness is different. And so those are, there's obviously a number of other issues, but those tend to be kind of the big ones. What should we pay attention to? How can I put them on an apples to apples basis? And how can I handle the fact that the risks might be different? And so if we look at the kind of overview of the steps of the capital budgeting process, you can see how this might help with that. So, step one, you're going to develop your pro forma financial statements, and that's very similar to what you guys have done with your projects so far. And so the nice thing about starting with pro forma financial statements, number one, they're based on standard accounting principles. And so there's, the firm handles things in a particular way. Every project should handle things in the same way. And so if that's the proper way for treating it, everybody will know that, and they have a resource in the accounting department that can help them with that. Number two, using that type of an approach kind of creates a consistent language for describing the opportunities. One person may want to talk to you about how if they invest in this marketing, that they'll have, so many more customers and so many more sales. Well, that's great, but you need to go through everything that's involved and basically put together a full set of financial pro formas and tell me how that impacts us bottom line wise. And that way you can put that on the same basis as something else. And it sort of forces everybody to become a bit more quantitative about their idea, and also forces them to think about what some of the other knock-on effects of their idea. And so if they're just taking account of revenue and they aren't thinking about the fact that, oh, wait a minute, we actually have to then make these products and that's gonna cost something. And we have to hire people and that's gonna cost something, and we have to have a place to store everything and that's gonna cost something. Then, by going through sort of all of the accounts in the accounting system and thinking about whether the project will have any impacts on those, it gives everybody sort of a structured way of checking and seeing if there's something they're missing. And then the nice last thing about that is, assume that you do decide to do a project, and it's now in place and rolling. You can now look at the financials that are coming out of the project versus what you said in your pro formas would happen, and see whether or not your actual performance maps well to your planned performance, whether it's higher or lower. The second step would be to determine the operating cash flows, and we'll talk more in detail about those in a minute, but the operating cash flow is a term for a specifically defined set of values that would be defined and viewed consistently across the project. And the real key to those is that they reflect the actual cash going into or leaving the business. And so you can derive those from the accounting statements, but in fact you don't rely simply on the accounting income. And quite frankly, by doing this and sort of reducing everything down to cash, you address many of the issues using this definition of what should and should not be considered in the projects. And again, we'll spend more time on what all should be in these operating cash flows here in just a minute. But basically in the process, by defining very specifically that number one, we're focused on cash, and number two, we're only focused on certain aspects of that cash, you sort of remove the guesswork and the possibility for inconsistency between the way different projects are evaluated. Third thing, once you've got those operating cash flows, you have to determine your capital costs. We've gone through this process already in class, obviously, talking about it, and so that the capital costs of a project are a function of its riskiness. And so, this is really the place in a project where if you say one project is more risky than another, and it's risky in a way that's meaningful to investors, then investors are going to demand a higher cost or higher return on their investment for that project, and that's going to be reflected in the cost of capital. And so we handle riskiness through this cost of capital step. And then once we have that, we calculate value added to the company. So in essence, the capital budgeting uses a metric called net present value, or NPV, to estimate value added. In essence, it's just the present value of all the cash flows from the project, including the monies that are invested in and the monies that are raised later on. And so it is, you can think of that as if somebody were to buy that project from you today, what would it be worth? And so since the decision that you're making right now is whether or not to do the project, ideally if it's valuable right now, if somebody would buy it from you for money right now, the right to do it, then it makes sense that it's good for the company. It adds value to the company. It increases the present value of the company. And of course, doing a present value, you need the cash flows on the top and you need the cost of capital on the bottom. So the calculation handles both of those. And again, as I said, it really reflects, in today's terms, takes into consideration the timing of when cash flows are going to happen and everything else, how much the value of your company is improved by doing these projects. So it really speaks to exactly the thing that you should be focusing on when you say a project's worth doing or not. And then you select the projects. So a project is viable. We'll spend more time on this in the next lesson. But a project is considered viable if it has a positive present value. or net present value. And so if it's negative, you wouldn't want to do the project anyway. All right? But if it's positive, then it's one that you would consider doing. Once you get all of the projects that have positive NPVs, then you can rank those projects either by net present value or something called profitability index. We'll go through that ranking process later. And so you could rank them in terms of which ones you like the best and which ones you like the least. And that way, when you find out how much money you have that you ultimately can raise for the investments, you know that you're going to allocate it first to the ones you like the best, and then kind of work down the list. And if you run out of money, you'll know that you got the best projects done first. Now, there are some complexities to that. Sometimes, for example, you may have one really big, expensive project that's at the top of your list. And if you do that project, you can't afford to do the 3 or 4 projects that are below it. And yet, if you do the 3 or 4 projects that are below it, they actually generate a total present value that's higher than that one project. And so, just based on the fact that either there's something about, an either or choice, we're going to use a building for either this or that, or just the total amount of money that's required or whatever else, what you want to do is you want to make sure that you take the combination that is an acceptable combination that gives you the highest combined present value among all of your investment decisions. So by doing that and thinking in terms of that, our overall goal is to pick from among these projects the combination that gives us the highest present value for the amount of money that we can raise. You have done the best job that you can do for the company. Now, talked a little bit in several places about this concept of the operating cash flows, and that's really at the heart of the capital budgeting process. Aside from getting these operating cash flows right, the capital, the net present value is really just doing time value of money, present value of the cash flows back to the current time, or the time when you assume the project will start. And so we've kind of already covered that process of getting present values, and so this is really the new item. So the learning objective is to identify the key features. Sorry about that. To identify the key features and talk about what makes these make sense in terms of how you think about cash flows. So here's kind of the summary of them. The operating cash flows should be cash, not earnings. They should be independent of any funding decision. They should be incremental cash flows only. You should consider only new investments, no sunk costs or cash flows. They should be on an after-tax basis, and they should include salvage terminal values whenever appropriate. Let's talk about each one of those one at a time. Cash, not earnings. The value to a company is based on the amount of cash that they receive in or pay out, and the timing of that. That's what creates its value, not accounting numbers. Accounting numbers often, they serve a particular purpose from a management standpoint, but in terms of determining valuation, they are not actual cash in many cases because, number one, they typically include non-cash expenses like depreciation. Number two, the earnings, when we think of net income on an income statement, doesn't reflect any sort of capital or investment, if you will, activity. So if I have to go spend a whole bunch of money to buy a new asset today, that's not going to be showing up in there. If at some point I take an asset that I have and sell it and raise money from selling it, that's not going to show up in there. If you think about the money that gets consumed in inventory and accounts payable, that's important, and that's not going to show up in the income statement. Money that you maybe can delay paying because of an accounts payable, there's a benefit to that, and that doesn't necessarily show up. And so, again, really disrupts sort of the amount and the timing of cash flows. And then, of course, just the fact that most accounting is done on an accrual basis means that you're shifting in the accounting statements the timing of when you recognize expenses and so forth, in some cases, to a different time than when the cash actually flows. And that, so you know, in summary, you may have some expenses that, or cash flows in the income statement that aren't really cash. You may ignore other things that actually are cash flows, and you may change the timing of when actual cash flows in other situations. So that for us is not an exciting thing, and as a result of that, we prefer to use cash not earnings. Second, it needs to be independent of the funding decision. We do understand that changing the amount of debt versus equity funding or the interest rate on debt can impact the amount of funding costs, and therefore it could, you know, if one group using one project makes one assumption about funding, another group makes another assumption about funding, they may reflect completely different cash flows, when in fact really the funding decision is assumed to kind of happen after you know, we decide whether we're going to do the project or not. I know that's not 100% true, but the bottom line is we do know that because of the interest expense that shows up on your income statements, you know, the decision of how much debt you're going to take on or what the interest rate is can affect your cash flows, your actual cash flows, not just your accounting cash flows. So from a capital budgeting standpoint, to kind of standardize, we just assume that everything's funded with equity, and so there's not going to be any debt. And while that we know that from an operating cash flow standpoint, from an actual cash flow standpoint, that's not entirely true, we need to make this assumption so that we can separate what the operating results of the business will be versus what the financing decision for the business will be. Now, so basically what that means is that when you build out your analysis, you should build it out initially on the assumption for cash flow, operating cash flows purposes, you should build it out on the assumption that you are 100% equity funded. Now, in practice, I can tell you that many companies do not properly handle the operating cash flows in this respect, because basically they just take whatever the existing financials are, much like we did, and including whatever the taxes are in those, and they just eliminate the interest charge and they think they've taken care of that. Well, if you think about it, your taxes are lower because of that interest charge, and therefore you've sort of created this extra benefit for yourself in terms of reduced taxes by assuming the interest funding, or the debt funding and the interest expense. But honestly, one of the reasons that they do that, you know, in our simplified examples, we often think in terms of, oh, the tax rate's 25% or 30% or whatever it is. And so you think I could just back out the consequences of the interest. In reality, the tax situation for companies can be very, very complex. So that backing out an interest expense, you know, from the tax calculation can be a very complex process. And so a lot of companies just sort of simplify on this by ignoring this. Again, the theoretically appropriate thing for them to do would be to build out a set of financial statements that assume no interest charges whatsoever, and use that as the basis for their calculations. But a lot of companies don't do that. This is a big one. Operating cash flows should be incremental cash flows only. And what we mean by incremental is, imagine sort of two states of the world, one state of the world where you decide to do the project, the other where you decide not to do the project, okay? The only thing that you want to include in operating cash flows are the difference between what your cash flows would be by doing the project versus not doing the project. And so the simplest way to do that is to have sort of a base set of operating cash flows that reflect not doing the project. then calculate sort of a full-blown set of cash flows before doing a project and just take the difference, okay? Now, sometimes that's just too complex in a business. If you have a project that really is somewhat independent to the rest of the business, we would call that like a bolt-on project. And so you can pretty easily define what the cash flows will be just exclusively from that. You can just calculate the cash flows for that project. But many times the decision inside of a company involves some complexities. If I do one project, for example, then I have to eliminate something that I'm already doing. If I do the project, and it not only get the direct benefits of the project, but it may also enhance, maybe it reduces costs someplace else, or it improves demand someplace else and adds revenue somewhere else in the company. I want that. Or it could be that it erodes the cash flows somewhere else in the company. I launch a new product and I've got the great cash flows from the product, but it sort of cannibalizes the sales on one of my existing products, and so those go down, and I want that to be reflected. And you can also have, it's very common inside of companies that a lot of their overhead expenses get allocated, and so kind of a surprising consequence if you aren't careful with this is the overhead expenses are the same whether I'm under whether I do the project or I don't do the project, and yet somehow you wind up charging the project for a share of additional overhead expenses that aren't actually going to happen. And so that becomes really confusing, and this sort of incremental cash flow rule helps to sort that out. I am not going to lie to you, this process of really determining what cash flows are incremental, what are not, and really thinking about that can be a very complex process inside of a company. But it's absolutely essential that you adhere to these rules, otherwise you're going to find yourself in some cases maybe unfairly penalizing a project by adding costs onto it that it doesn't really have, or unfairly rewarding a project by ignoring some costs or some consequences that it has elsewhere in the company. So it's very important to go through this process. Now, in the project that we did, you're starting with nothing, and you're building a business idea into a business from scratch, and therefore all your cash flows are incremental cash flows. If you do nothing, you have nothing. So that's why we did this project, was that it's so much easier than dealing with those incremental cash flow issues. But it's important for you to understand this. Next thing, only new investments, no sunk costs. A sunk cost, what we refer to as a sunk cost, is something that at the time, let's just say that you're standing at a point in time and you're making the decision to go forward with a project or to do something else or whatever else. And prior to that point in time, you may have already spent some money researching the different choices and all of that sort of stuff. And there is a temptation to want to charge your project for all of the costs of things that you've already spent, basically trying to decide whether to do the project, getting all the information, whatever else. And you should not do that. And for a couple of reasons. One is that decision was already taken. The decision to do the step of evaluating or gathering the information or spending money on that was taken before that decision's no longer available to you. The money's already been spent. Secondly, remember that this is you're supposed to be looking only at incremental differences between whether I take this next decision or I don't. And you can't undo those sunk costs. They're spent either way. And so if I thought again about this idea of what would the cash flows be if I didn't do the project, what would the cash flows be if I did do the project, these things that have already been spent would be the same either way. And so if you're going to load both of those with that, the difference between them cancels out that sunk cost, and it gets eliminated anyway. One other thing, you should always evaluate your projects on an after-tax basis, meaning that you want to figure out what the consequences of taxes are and reflect cash flows that are left over after you've paid the taxes. And a lot of times this doesn't matter, but there are times when it can. Sometimes one of the primary benefits of a business opportunity comes in how it affects the overall tax expense for the company. So, sometimes, for example, a taxing authority, whether that's the federal government or a state or whatever else, will offer up tax breaks or tax credits to encourage companies to do certain things or make certain investments. And if the company does the project, let's say they get these benefits. And if they don't do the project, they don't get the benefits. Well, the benefits themselves could be very valuable. And so if you ignore those tax benefits, you might look at a project and basically say, well, it's not a very good project, so maybe we shouldn't do it. But if you include those tax benefits, you're like, it's actually a really good project, we should do it. Well, stop and think about it for a second. If doing projects made sense even without a tax benefit, then the government agencies wouldn't need to offer you those benefits to encourage you to do it. And so more likely than not, in situations where there is a tax benefit being offered by the government, it's because the project either isn't viable or is barely viable without the benefit, and it's really the benefit that makes it worthwhile. And so, it's important for you to factor the cash flows from that tax benefit in making your decision. All right. Last thing, you should include salvage/terminal values. Here's the deal. Sometimes investments are very long-lived, and so you don't go out and build out pro formas for the entire life of the investment. Look at the business opportunity that you guys have put together. We built pro formas out for 10 years, but the business, if it's successful, may go well beyond that. Well, you still need to somehow give the project credit for the fact that, oh, by the way, there's going to continue to be value beyond the end of the pro formas. And so we do that through something called a terminal value. And we used sort of a simplified perpetuity calculation for that. There are other methods that you can use. But when you're trying to say, oh, and here's the rest of the value all the way out until the end of the useful life of the project, you're giving it its terminal value. Now, there are other projects where, over the time frame of your pro forma, you maybe buy an asset and then at some point it wears out or you no longer need it or whatever else. And so it's very easy to just do nothing with it. But in fact, from a project modeling standpoint, but in fact in the real world you wouldn't do nothing with it. You would probably try and find somebody that wants to buy it, even if they're just buying it for scrap. But they're going to you're going to get some money from selling that thing off possibly. And so that's called its salvage value. And you want to make sure that you reflect the salvage value of the assets in the evaluation as well, particularly if those are going to happen relatively early on in the project, or if you think that the salvage value is going to be quite high. A really good common sort of example of salvage value comes from, say, land. Let's say that you have to buy some land to put a building on, and for the project, and you're only going to need that land and that building for 5 years, and once that's done, you're going to be in a position where you're going to move on to do something else, or find outsource that or whatever else. But in the short term, you need that land and that building. Well, at the end of the 5 years, you don't just walk away from that land and that building. You turn around and sell it to somebody. And you may actually sell it for more than you bought it for. So it could be a very big number that offsets the original investment amount. So it's important for you to do that. Now, I make a distinction in here between salvage and terminal values. It's not as important to me that you know the difference between one and the other. It's more important for me that you recognize that sometimes you've got this extra cash flow that comes from getting out of your project or selling off an asset or whatever that you want to make sure that you include. Anyway, so those are kind of the big gotchas for capital budgeting. really from an operating cash flow standpoint. And, you know, we will get into, obviously, we've done more of an applied version of that in our project, but we'll get into how we sort of piece all of that together over the next two discussions.